Welcome to the InterMarket Analysis video update. This is a video that I do once a week where I look at a couple of different things, but I put them under the umbrella of InterMarket Analysis. We look at S&P 500 valuation. We look backwards to see what's already happened, and then we look forward because that's what the market uses to gauge if it's going to go up or down based on earnings. Then I do a study of growth versus value, and then from there, I go into an intermarket look across different indexes, across different sectors, just to get some comparisons to see what's going on in other markets, because sometimes that can bleed through and actually have an impact on stocks in general and the S&P 500 more in particular. Also, I want to let you know as I'm recording this, it's over Memorial Weekend. Where I currently reside right now, there's some geopolitical things going on. It starts with a P, ends with an N, and it's Uti in the middle is paying a visit, and they've throttled down the internet. And so it's been really difficult for me to be able to upload. I can download just fine. I just can't get the videos uploaded after I record them. I finally got the daily video and weekly videos uploaded after many hours. Now we'll see how long it takes this one to actually be posted. This is being prepared for Tuesday, May 28th. That's one good thing about why this is happening or when this is happening, because I have an extra day with the market being closed on Monday. The first area is S&P 500 valuation. This is looking back, called the TTM, or trailing 12 months. And we can plot this on a chart. And what they do is the red dashed line, that's a PE ratio of 20. When we get to that level and above, the market is considered to be expensive on a historical basis. And right now you can see the S&P is way above this red dashed line. If we were to drop, if we got down to the blue line, that would be a PE ratio of 15. If we got all the way down to the green line, that would be a PE ratio of 10. That's when the market is considered to be inexpensive or cheap. Because we're above the red line, I blow that up down below just to give you an idea how far we are above zero here. So on a historical basis, this tells us that we are expensive. But looking at different events that have happened, we can stay above the red dashed line for years at a time. Now, if you're a fundamental investor, you probably pay attention to these things. We use this more for information. We just want to know, what is the market doing? What kind of condition is it in right now? Because it can stay that way for many years at a time. So we don't really focus on that as far as when do we get in, when do we get out. Another approach to this is taking more of a smoothed effect over a 10-year period of time. This was developed by Robert Shiller. It's called the Shiller PE ratio. You may also hear it referred to as CAPE, C-A-P-E. I've also seen it as PE 10. How he calculates things, we currently come up with a value of 34.71. To give that some context, we can look at a historical chart going well back into the 1800s, so you can see different events that have happened and where we're at right now. Where we get a little bit more of a refined look is when we look inside this red box. Over the period of time that's on the chart, we have a median and a mean between about 16 and 17. Okay, we're at 34. So even looking at things this way, we're also considered to be overvalued. But we've been this way for a long time. Market doesn't do that. It looks forward. And just to give this some other context, in red is the S&P 500, currently coming in at 20.6 as of Friday's close. The context is here are the mid caps, that's in blue, they're at 15.4, and in green are the small caps at 14.4. Now, these areas are not considered to be expensive. The mid caps and the small caps have been pretty strong, but the small caps have been really chopping sideways for all of 2024. Just because they're fairly priced does not necessarily mean it's a good time to get into them, but that can change. That's why I watch these things. We keep an eye on all the different areas of the market, even though we finally focus, at least I do, on the S&P 500. Then we look at growth versus value. This is just a pure growth index where it's in an uptrend. We had been coming down as we were seeing some pressure throughout April. Now we're starting to come back up. We've kind of chopped sideways, but we are in an uptrend. This is looking at growth all by itself. Then we look at value all by itself with also a peer value index. This has been falling back a little bit over the last few trading sessions, and we're seeing a little bit of strength here. growth has been going sideways, not really going up, but value has been actually declining, and that's helping a little bit the overall condition. But we want to see more than what we've been seeing so far. Where we can do some analysis is when we do ratios between them. On top is growth versus value. And lately, this has been going up. And that's what we want to see if we're more positive. Now, on bottom, I have an inverse of that same ratio, but you can see where it's offset a little bit when we have this moving average crossover. That's why I do things like this. If I'm making decisions on if growth versus value, which one's doing better, I want to see the same thing at the same time. And after this, I have a lot of additional charts that break down growth and value even more. Here's an ETF. Longer term, we go back further, all the way back into 2004, where we are seeing on a longer term basis an uptrend of growth versus value. And that's what we want to see in a more positive environment. This is an inverse of that same study. Seeing here where value is underperforming growth. Okay, that's looking positive now. Then we do another ratio. This is the same ratio I showed before, but much longer term here. It's a little more choppy, but growth is still outperforming value. Then a little shorter time frame here. When we're going down like this just means that growth is outperforming because value is underperforming at this point. And here's another one, the S&P, another ratio, also showing where growth is outperforming. Okay, so this is showing some improvement from what we were seeing about a week ago. Then we do some ETFs, different ones here. We do a ratio, and this is coming up outside of the rainbow. So as of Friday's session, this is really showing some improvement. Now, we had a pretty big down day on Thursday, and a lot of these things were starting to show some weakness. But Friday, we had enough of an up day for these ratios to actually look a little bit better. Here's an inverse of that, showing how value has been underperforming when compared to growth. Has been underperforming. Then we break it down a little bit more. We just look at small cap growth to value, where it's been chopping more or less sideways, not showing a lot of strength, but we did tick up on Friday. We want to see this ratio keep going up if we're going to be more positive with the small caps. That same similar thing with mid caps. We did come up on Friday. We're below the 200-day moving average with this ratio. We want to see this really go up to turn more positive with the mid caps. We're seeing a little bit of improvement when we look at the S&P growth to value ratio, but we want to see this continue to go up to be more positive for the S&P. Then we keep an eye on inflation. On top is a monthly chart, and we've been pretty much going sideways now, a little bit up lately. There's been some concern in the markets that maybe inflation's starting to come back in. And so when that happens, we tend to see more of a rise in commodities, and that's what the CRB index measures. Then we do a ratio down below of inflation versus deflation. We have been coming back up, but we're still under a declining moving average, meaning that inflation is not necessarily a problem on a longer term basis, at least yet. And here's a daily chart of the CRB where it was going up, it pulled back, but now it's starting to go up again, and it's in an uptrend. The Baltic Dry Index. There are people that mix this all up and they shift things forward and they try to match up what happened before with what might happen in the future. I just look at the S&P on top and the Baltic Dry Index on the bottom. What this measures is shipping products from one place to another, specifically in the Baltics. And when this is going up, that tends to be more inflationary. When this is going down, that's deflationary. We've been really chopping around now. It's a weakening uptrend, but we're still in an uptrend with this index. Some other markets that we just look at, usually on a weekly basis, unless we hear the news and we want to check up on something, like gold's been really big lately, but you probably don't hear about the aluminum market very much. It's been bouncing back up, and this could be considered somewhat inflationary. We're also coming back up a little bit with corn. It's coming back up to its 200-day moving average, but it is also in a longer-term decline still. We look at wheat, which has been bouncing back up too, but still in a downtrend, but we could see a crossover here pretty soon to turn this trend positive. And we keep an eye on fertilizer because that's kind of the foundation of growing things, where it's not really spiking up. It's been pretty much flat lately, but this chart just goes back 3 months. Give us an idea of what recent prices are like. Keep an eye on oil. It really spiked up when things were flaring up in Israel and kind of all over the Middle East. Since then, it's been pulling back. It's still in an uptrend, but it has dropped below both moving averages. Gas, which is in an uptrend, but has been pulling back. That's like the overall dream of every politician, is to have gas prices go down right before Memorial Weekend. So no real surprise here, but it is still in an uptrend. And we look at diesel, also has been dropping off. This is for railroads and 18-wheelers and shipping products all around the country. And so this going down just means it's less expensive to send those things from point A to point B. Heating oil, it's kind of hitting the summer months now, so it's tending to go down. Now, I wouldn't necessarily base this on seasonal patterns. I just look at this chart. I'm not an expert about this market at all. Natural gas has been coming back up too after just really, really going down lately. Copper, this is called Dr. Copper because it's like, how's the health of the economy? When copper is going up, that tends to mean a brighter economic future. It's not always right, but it's what we watch and keep an eye on. When copper's going down, that means maybe the economy is going to get sick. Well, it's been really just shooting up and set a new high here. I don't have a long enough chart to know if this is an all-time high, but a pretty high, higher than it's been in the last number of years. But then we came well off of that. We hit this level, and then they decided to come in and start pocketing those profits. We look at a copper to gold ratio, where copper has been outperforming. Gold's been doing well too, but copper's been doing even better. The last couple of days, this past week, we saw this ratio falling back. It's still in a longer term uptrend, though. We just saw a crossover here, meaning that copper is outperforming gold. And here's a longer term look at that same chart. And then I also plot the 10-year and the 2-year yield on here just to see if we can get some insight from this. But there's quite a wide spread between all of these, where you can see back from about 2012 to 2016, they were pretty close to each other, even though they're all on different scales, but they had a tendency to move more in the same direction. We haven't seen that for the past few years now, but we just want to keep an eye on this to see, okay, can we get any insight from this? And not really. We're just mainly watching copper outperform gold. That's really kind of the takeaway I'm getting. Here is gold. Just looking at the ETF, it's still in an uptrend. It's kind of coming up here. Some people could say, ooh, a double top, and it's been pulling back from that. We'll see if we come down to the moving average at all. Now, this is not the futures contract. This is just the gold ETF, and that's why you see a little bit of a discrepancy with prices when they're talking about it in the financial media or other places. Silver is also in an uptrend, but has been pulling back after setting some pretty high readings. It's also looking positive longer term still. Then we do the closing value of gold on top, the closing value of silver on bottom, and we look at the correlation between the two, because it only stands to reason. If gold is going up, silver should be going up. Okay, well, let's prove that looking at charts. And even though this correlation is dropping off a little bit, they're still having a pretty strong one-to-one relationship. This is not measuring direction. This measures, are they going up together or down together? And they were pretty strong here, as we saw both gold and silver really breaking out. Then we have a gold to silver ratio on top. And then in the middle is the US dollar index. And we look at the correlation between the top part of the chart and the middle part of the chart. And this correlation is fairly strong right now. So this ratio that we're seeing is actually lining up pretty good with what the dollar is doing right now. So if we're seeing weakness in this ratio, we might end up seeing weakness in the dollar as well. And that would be more positive for stocks. The stock market likes a weaker dollar. Here is the dollar. It's still in an uptrend, but it has been pulling back. When it's going up, that pressures stocks because exchange rates are less when the dollar goes up. If the dollar goes down, then it looks like, ooh, a company gets more money and that looks better on their books. It also helps the relationship between imports and exports when the dollar is weaker. Now, the official stance of the U.S. government is that we have a strong dollar. The unofficial stance of the U.S. government is that we have a weak dollar. All right, here's another look at over the last 3 years. We were finally able to break out with the dollar, but now we're coming back down a little bit when we crossed above this downward sloping trend line. Then we have the euro on top, which has really been choppy lately, and the US dollar index here. This is just to give us more of a visual take on both currencies. And then to add another one, we have the Japanese yen on top, the euro in the middle, and the US dollar index down below. Here's where I break it out, where we just look at the euro versus the dollar. It is in a slight downtrend, even though the euro's been bouncing back lately, and it's above both moving averages. So, they're not quite at par, meaning they're not really even with each other, but this might be a little bit more of an advantageous time if you want to go to Europe these days. You'll get a slightly better exchange rate. Here's the Japanese yen. You see the spike up here right at its first part of May? They think, now I've heard it said in an official and unofficial way, that they think the Japanese government came in and tried to buy a bunch of yen to prop up the yen against the dollar. I don't have anything official about that. But longer term, the yen has been declining when compared to the US dollar. Here's the British pound. Also in an uptrend, and we were able to cross above both moving averages here. So not quite as friendly of an exchange rate if you want to go to England right now. And then we look at some different ratios between indexes. This is the S&P 500 weighted index. That's the bar chart that you see. And then we have the equal weight index. That's the red line. And it's really been the S&P that's been outperforming, because that is a weighted index based on capitalization. So if the Magnificent Seven stocks do really good, that helps the S&P. Well, the equal weight, it treats all stocks in the S&P the same. So it gives us kind of a little more realistic look at things. Then we look at a ratio between the equal weight and S&P. When this is going down, like it is right now, that means the big stocks are outperforming the rest of the market. And that's what we saw as we were really going up. You see where we were going up with the S&P well into the COVID crash. Well, we saw this ratio declining. And then we went all crazy for a while. And then we saw this ratio actually going up. And then we got it out of 2022 finally. And since then, we've been seeing this ratio going down. And that's when we've seen the S&P really start to go up. But on the other hand, we want to see this ratio doing pretty good. That just means the whole broad market is doing better. And we look at a ratio between stocks and commodities, showing that stocks are continuing to outperform commodities, even though both are in uptrends independently. Here's an inverse showing how commodities are underperforming stocks. We look at the NASDAQ 100, which is just coming off of setting an all-time high on Friday, and the S&P 500, which set an all-time high earlier in the week. And we had come down and we were showing some weakness. And this was producing some concern, because these are the big stocks, the big tech stocks, the Magnificent Seven and the NASDAQ 100. And we were seeing this ratio coming down. We actually got to the point where we were almost seeing a death cross. Well, over the past week, this has really started to show some improvement. And if it can keep going up, turn these moving averages back up, that would probably be more positive for the market. The S&P 100, which are the biggest stocks in the S&P 500, it's looking more solid. So it bounces around, but it's looking like there's a little bit more conviction in the bigger stocks in the S&P 500. Then we look at the NASDAQ and do a ratio with the S&P 500. Both are doing great. The NASDAQ set an all-time high on Friday. The S&P set one earlier in the week. But the NASDAQ is now coming back to the point of actually showing an improvement and outperforming the S&P. We look at the NASDAQ 100, the biggest stocks in the NASDAQ, and compare it with the NASDAQ itself. We were getting some concern here, and we're still kind of concerned. When we were really headed up, that means the NASDAQ 100 was outperforming. We've seen that start to drop off. We actually saw a death cross with this ratio, but now we're coming back up to the 50-day moving average of this ratio. If we can keep going up, that would turn things even more positive. Then we look at the mega caps, the really big companies, and compare it with the equal weight ratio. When this is going up, that means that the big companies are outperforming the rest of the market. We do a ratio between small caps and the S&P. That's the red line. And this has been a real area of disappointment, really going back to late 2022. This red line is, we saw a little bit of hope right at the end of 2023, but in 2024, this is the one area of the market that's really under pressure, and it's just been going sideways in a range. If we could see things get to the point where small caps do well, that probably means that we're in a more interest rate friendly environment that might help boost the rest of the market, because these are smaller companies and it's more of an impact on them if they have to borrow money. And if interest rates are going up, that means it's costing them more to borrow that money, and it's going to go over into their earnings. Where larger companies, it's a little bit easier for them to absorb those extra costs. And we look at a ratio between the small caps and the S&P, and you can see they just continue to underperform when compared with each other. The biggest software companies, this has been a little bit of a disappointment. We are in an uptrend, but just not really breaking out like we were back in 2020, 2021. Then we started to see things go sideways, even in 2021 before we hit 2022. But this is a big part of the tech sector. And so we would like to see this really performing better than it has been. Mega cap growth. This is where everything's at these days, with NVIDIA being at the top of the list. And this is strong and going to new all-time highs. The robotics and AI ETF. This is what everyone's raging about. When you look at it all by itself, yeah, it's coming up out of the rainbow and looks kind of good, doesn't it? But look at what happens when you compare it to the tech sector. It hit the top end of this rainbow a couple of times and is underperforming the tech sector. So where's all that rage go now? All right, the Dow Jones Composite, it came down on Friday, but it's been in a longer term uptrend. Now, this takes the Dow, the transports, and the utilities together and puts them into one composite average. The Dow it's been one of the weaker indexes, even though it set an all-time high this past week. The utilities have just been screaming to the upside, but the transports have been really lagging. The strength that we're seeing is really coming from the Dow, and lately it's been coming from the utilities. Here's a ratio between the S&P 500 and 1 to 3 year bonds. When we're coming up out of the rainbow, that means the S&P is outperforming short-term bonds. Then we look at the S&P 1500 and also compare it with short-term bonds. This, even though it came down a little bit, is showing that on a broad market basis, the S&P 1500 is outperforming short-term bonds. We look at another broad market measure, compare it with a little further out bonds, 3 to 7 years, also well above the rainbow. Here's the total stock ETF, which is 2,651 stocks last time I checked. We're coming off of just setting recent all-time highs. So that also suggests that parts of the broad market are improving. Low volatility. These are stocks that folks like to get into when they're concerned that we're going to be going down. Well, this has been in an uptrend as well when you look at it by itself. But when you compare it to the S&P, it's been really underperforming and starting to break even down to new lows with this ratio. We look at the tech sector, compare it with bonds. Tech sector is outperforming there. And then we look at some other ways of analyzing stocks. I show this in the daily video. This is what I call the advanced decline line studies. We look at the NYSE common stock, the S&P, the mid caps, and the small caps. The takeaway from this is that we're above the moving average with all of these, and we ticked up a little bit in Friday's session after we had a pretty significant down day on Thursday. Then we look at Dow theory. The Dow is just coming off of setting a recent all-time high, but has since been pulling back. The transports have been going sideways. Utilities are just screaming to the upside, but now are starting to pull back. We're keeping an eye on utilities. This is more of a defensive area. Folks get into this when they're concerned that the market is going to start to go down. Is this telling us something, or is this just an anomaly? Now, there's two ways to look at this. Yes, the market's getting more defensive because we saw that near the end of 2021. But then there's some research by Jason Gepfert, who runs a site called sentimenttrader.com, who looked at previous times when this happened, and he found 12 times, and 10 out of those 12 times, the market was up 6 to 12 months later. Now, that might be a little far off into the future for some of you, but longer term, things are okay. Shorter term, it might produce some kind of a problem. And we'll look at the transports all by themselves, and they're just not doing really well these days. They've been really underperforming. We look at a ratio between the transports and the S&P, and look how this is just going down, down, down. The Dow to transports, when this is going up, that means the Dow is outperforming the transports, and that's pretty much what's been happening here. We look at a relationship between the S&P on top and the transports and show that the relationship is not very strong. The S&P is just doing what it wants to do while the transports just go down to sideways at best. Then we look at a new idea behind Dow theory. Traditional Dow theory is Dow and the transports. I add my own extra thing by putting the utilities in there. Well, if we want to get more modern with this, instead of using the Dow, which is just 30 stocks, why not use the S&P 500? And then instead of using transports, because when it was first developed, that was for railroad stocks, why don't we use the NASDAQ now? Because we're more of a tech-based society. And this just gives us an idea. Are they confirming each other? By looking at this, we're breaking out to new highs with the NASDAQ. We set an all-time high, but not in Friday's session like the NASDAQ did. Now, this is another little takeaway. Instead of using the S&P, why don't we use the equal weight S&P? Maybe that'll be more fair. And instead of using the whole NASDAQ, why don't we just use the NASDAQ 100 QQQs and then make that equal weight so everything is treated the same? And we're breaking out with both of these. Now, there is a potential negative divergence here. We set an all-time high with the S&P. We have not set a new all-time high with the S&P equal weight. We set an all-time high with the NASDAQ 100. We have not set an all-time high with the QQQs or the NASDAQ 100 equal weight, at least yet. This is a little bit of a concern. We want to keep an eye on this chart. If we see more strength in the market, we want to see both of these charts confirm the all-time high that we're seeing in the regular indexes. FANG index coming off, well, it actually closed at an all-time high, but not an intraday high, because Thursday was pretty bad for the market. And then I keep this on here just in case we start to really fall. I'm looking for different areas of support. The Wilshire, another broad market index, not setting an all-time high, but still looking pretty good. ARC, been a real disappointment, floating around like it's in a flood or something, and just kind of floundering. 2023 into 2024 has not been a really good year. I don't know a lot about ARC. I follow it here because I know a lot of people that watch these videos do invest in ARC. And we have an all-world ETF, but we take out US stocks. This is just showing that the rest of the world's looking pretty solid on a stock market basis, even though it might be going crazy. And then we do a ratio between the SPY, that's the S&P 500, and the rest of the world, showing that the S&P 500 is outperforming. And then we have a longer term chart here. We look at the S&P 500 and then a longer term global look at stocks in Europe, Australia, Asia, and the Far East. We're above the moving average and going up. That's positive longer term. We're flattening out a little bit with the percentage price oscillator here. That would be more positive. Now, this is a monthly chart, so this takes a while for this to develop. It would be more positive if this oscillator here was to turn and actually go back up. Then we keep an eye on bonds. This is a total bond ETF. This looks at bonds based on price. When bond prices are going up, interest rates are coming down. We've been chopping all around. We came down to the 200-day moving average. Now we're up back to battling with the 50-day moving average. If we could break out with this ETF, that would really help interest rates go lower. In fact, they would go lower, just wouldn't help them. Here's a world bond index where we've been just bouncing crazy all over the place. It's really, I don't even know if we're really in a trend right now. Everything's just kind of a jumbled mess over here. We look at a monthly chart of the stock to bond ratio, and this has been showing now for a number of years that stocks continue to outperform bonds. This is confirming that. Another daily chart showing how bonds are underperforming stocks. Then we have high yield corporate bonds. These are also called junk bonds. These are coming off of setting recent all-time highs. And this ETF tends to follow the stock market. We look at more conservative bonds called investment grade bonds. They're also in an uptrend, been chopping around, came down to their 200-day moving average, trying to bounce up and get above its 50-day moving average and then stay there, but still a long ways to go to get back to these all-time highs. Then we look at a ratio between riskier bonds like junk bonds and more conservative bonds like well-established corporations and even government bonds. When this is going up, folks are preferring the riskier bonds. They give a higher yield. Folks are willing to take on that risk to get a better return. We look at a correlation between stocks and bonds coming down a little bit, but a pretty strong tendency. If stocks are going up, bonds are probably going up. If bonds are going down, stocks are probably going down. Now, this changes all the time, but for right now, they seem to be going in the same direction at the same time. We look at the corporate bond index, which has been going sideways for most of 2024, even though it's still in a longer-term uptrend. We'd keep some Fibonacci lines on here with the 10-year yield, and we're not really near any of those lines currently. And this is a longer term look at the 10-year yield, where for 40 years we saw lower highs and lower lows. Now we're possibly going back into a new environment. And we've been in this now, going back to 2022. What we've seen over the last 40 years is not the norm. The norm is a higher interest rate environment. And so stocks are having to adjust to that possibility, and keeping an eye on this chart just helps us to know what's going on there. We also have some Fibonacci levels here with the 30-year yield, but we're not near any of those lines now. We do a ratio between the S&P 500 and the 10-year yield, showing how the S&P has been roaring back lately after it had been showing some weakness as we were going down in April. Here's another look at bonds to stocks. And I've been showing this chart a lot in the daily videos, because when this ratio is going down, that's more positive. That means stocks are outperforming bonds. And if we want to be more positive on things, we want to see this ratio continue to fall. Junk bonds coming back and just setting recent all-time highs. We look at a ratio between junk bonds and more conservative bonds, showing how junk bonds are outperforming even though they have pulled back recently. We look at the 7 to 10-year bond ETF. Now, this is based on price. And so as this has been going down, that means interest rates are going back up, but we're still above the 50-day moving average. The longer term, or the shorter term momentum, is still positive, but it's rolling over. We're still above 50 when we look at the RSI. The longer term trend is the 50 is still above the 200, so that is still a positive trend, even though it's kind of going down. This is a daily chart of the different yields where we had been going up, and now we're starting to see the wave kind of coming back down. We'll have to see. Can we continue to fall? That would be more positive for stocks. Here's a weekly chart looking internationally. We ticked up with US, UK, and German rates, and even Japanese rates. Can you imagine that? They're above 1% now. Haven't seen that in a while. They were actually negative for a long time. Then we look at the MOVE index, which measures the volatility of bonds, and that's been going down as bonds have been going up. The VIX, which measures the volatility of stocks, that's also been going down. And there's a fairly high correlation between the two. Now, this doesn't measure direction. This just measures, are they moving in the same direction at the same time? Then here's a chart that I found. This is the Bank of America MOVE index. This is just another look at what I just showed you, as the MOVE index has been dropping as bonds have been going back up. Oh, and going back to this is a relatively new index. We don't have a lot of, or I don't have a lot of historical data to really test this, so I'm kind of testing this under real-time conditions. It's only been around for a few years. Now we look at a monthly chart of the 30-year bond, which has been going down, and it's below its moving average. Then on the bottom, we look at a ratio of bonds to commodities, where bonds are still outperforming on a longer-term basis, even though commodities have been doing pretty good. Then we look at some different sectors, and I break this down first by looking at just the sector, which is shown here in alphabetical order according to their symbol, XLB. That's why this one comes up first. These are materials. When you look at them by themselves, they are in an uptrend. When you compare them to the S&P, they are underperforming. And we look at communication. Looking at it by itself, it's in an uptrend, and it's actually starting to show a little bit of improvement, but this is where a lot of the upward move comes from. We want to see communication really outperforming if the market's going to turn more positive. Then we look at energy, which had been really going up, and since that time has been falling back. When we compare it to the S&P, though, it's really starting to underperform, even though it had been bouncing up since about the middle or early part of March. Here's financials, looking pretty good when we look at them all by themselves, kind of showing a little bit of weakness, but still in an uptrend compared to the S&P. Industrials also coming down to their 50-day moving average and really showing a real underperformance now when compared to the S&P, but still in an uptrend, but really have been declining lately. Tech, this is the darling. This is what everybody loves. It's in an uptrend right now, and it's actually looking a little bit better on a ratio basis. We want to see this keep going up if we're going to stay more positive on the market. Staples, another thing that we've been watching. This is more defensive. And if we go back here to late 2021, we saw Staples really going up, And then we hit 2022, which was like the year from hell for a lot of people. Well, you can see we were in a more pronounced uptrend here, and that's causing some concern. And we're keeping an eye on this right now. But when we compare it to the S&P, even though by itself it's in an uptrend, it had been bouncing back up. And this is when I was really starting to pay attention to this. If we continue to fall with this ratio, that could turn things back more positive. Real estate, it's kind of all over the place. It's still on a longer term uptrend. We saw some weakness, then a bounce back up. Lately, it's been going back down. When we compare it to the S&P, it's really been underperforming. Utilities, really strong in an uptrend, kind of causing some concern. This is a more defensive area. And when we look at the ratio, it's been coming up and strong, but it's still in a longer term uptrend. We have yet to see a crossover here with this ratio. Here's another thing that I look at pretty much every day in the daily videos. When this is going up, this means the S&P is outperforming utilities. When this is going down, that means utilities are outperforming. We want this ratio to go up. And lately, it's really been coming down. If this could turn and start to go back up, that would probably be more positive. Now, there are times when these two kind of deviate here, but it would just be more positive for the S&P itself. And then this is the research that I alluded to earlier with utilities and staples getting really close to their 52-week highs, even though they pulled back this past week. I actually had this up here a week ago, so this is a little bit older. This was on May 15th. And it says stocks have been recovering since the April pullback. All right, but most indexes are still off their highs. Well, this was before we set a new all-time high, right after he posted this. Most sectors are too, except for two, the most defensive ones. And bears suggest, these are people that thinks the market's always going to go down. If staples and utilities lead the charge higher, this rally is not to be trusted. And I have to admit, it's caught my eye, and I'm keeping an eye on this. But historically, the S&P did just fine. But longer term, if you go 6 to 12 months out, there were only 2 losses out of the 12 signals that were triggered. But it might mean more shorter term weakness. And we look at healthcare, another defensive area. It's in a longer term uptrend, showing a little bounce here. So we want to keep an eye on this. But when we compare it to the S&P, really underperforming. Discretionary, this is the thing that makes life fun. It's in an uptrend, but not doing as good as we would like to see, even when we look at this all by itself. And it's really underperforming the S&P. And a lot of this has to do with Tesla being under a lot of pressure these days. It's really in a downtrend with this ratio. Semiconductors, a real benchmark of the whole tech sector, coming back and just recently, at least on an intraday basis, setting an all-time high. It had a pretty good week, and it's been really going up lately, and that could be really positive for the market. We look at energy, which was starting to go back up, and then compare it with the tech sector, which energy had been underperforming, but we started to see it coming back up. Now energy is starting to go back and underperform. We look at growth stocks and compare them with bonds, where growth stocks are outperforming. Probably no real surprise there, but here you have proof. The tech sector compared to the 10-year yield, it shows that the tech sector had been showing some weakness as interest rates are going up and tech stocks are going down. Now we seem to be showing some improvement here. Here's an inverse of that same thing, showing how the 10-year yield lately has been weakening compared to the tech sector. Discretionary versus staples. We want to see this going up. It's going down, and we've seen a death cross here. This is a concern to us. We want to see this really marching higher. So that's one of the areas that are kind of a disappointment right now. Here's an inverse showing how staples are back to outperforming discretionary. Staples, a defensive area, discretionary, a growth area. To see this ratio going up is a concern. Gold to the S&P. You know, everyone's saying gold, 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 breaking out, doing really great. Well, when you look at this ratio, it's like they're kind of doing about the same. And one's not necessarily outperforming the other right now. But on a trending basis, gold is outperforming. But lately, we've been seeing a pullback in gold and a pullback in this ratio. Also with the dollar breaking out above this trend line, but we've been seeing a pullback lately. This is a chart that I really focus on. High leverage loans. Very risky loans. The people that invest in this are smart, okay? And if they thought that everything was going to fall apart, they would not want to be in this ETF. But look at what's happening. We've been in a sustained uptrend. We really established it back in early 2023, and we've just been marching higher ever since. If this really starts to fall, that's going to be a bigger warning sign. Right now, that gives us a little more confidence in the market. The NYSE Composite, a broad market index, coming back up above its 50-day moving average. All stocks, also above its 50-day moving average. Emerging markets, showing a little bit of life here. Been going sideways for a lot of 2023 into 2024. Now starting to go back up. The Japanese Nikkei, after coming back and finally getting back to the all-time high in 1989, it's been pulling back lately, but it's trying to come back and give that the old college try again. The micro caps also are in an uptrend. These are the really small companies on a relative basis. And we look at the S&P on top, and we have this home builders ETF. And I'm not really seeing anything here. What I'm looking for are divergences in the correlation. When we get down to really low readings, well, right now they're going in the same direction at the same time. So we're not really getting any warning signs from this. If anything, it's a confirmation that things are looking okay. Bitcoin, yeah, it fell back, but now it's back up into the 70 range. I guess it's at 69 at the time I got this chart. And we look internationally. China has been going up, but you see how this is starting to roll over? Also, just a little bit of a rollover here with emerging markets. Still looking okay in Europe, Japan, and the US. Now, this is a longer-term oscillator, so it doesn't move around as much as some of the other oscillators that we use. InterMarket Analysis. We have gold and oil pretty much tied for the lead now, with stocks in either second or third place, followed by the dollar, and then bonds going back to the beginning of the year are still negative. Then we look at some correlations. The S&P to the dollar. They're having a pretty strong tendency to go in opposite directions. That's why I say when the dollar's going down, that helps stocks go up and vice versa. That's being pretty much confirmed by what we're seeing in this chart. We also look at S&P to gold, and that's neutral right now, not going the same direction, not going in opposite directions. We look at the S&P to the 10-year yield, also fairly strong, but getting a little bit weaker, but tendency to go in opposite directions. We look at the 2-year yield, also getting back into neutral, but was really showing that they were going in opposite directions. But now we're seeing this coming back up a little bit. And we look at the tech sector, the 10-year yield, and why are things going crazy with these charts? I'm not really sure what's going on. I'm almost done with this video, and I'm not going to start again. Okay, some long-term charts. This is a monthly chart of the NYSE. We're above the moving average, and the moving average is going up. The Copic curve, which is a momentum oscillator, is also going up. This is a daily chart. The indicator on the bottom continues to go up. That's positive. So we have a monthly chart and a daily chart. And then in the weekly video, I go through a weekly chart, and they're all confirming each other to be in positive trends. Here's a monthly chart of the S&P 500. We're above the moving average, and the moving average is going up. The PPO was starting to roll over, but now it's beginning to turn back up. That is longer-term positive for the S&P. We look at a ratio between the S&P and commodities, where when this is going up, that means stocks are outperforming. Then we look at the S&P to another global index on a monthly chart, and we're pretty much flat here. But the KST, it can take a while to shift around. All right, then at the end, I go through a list and I say what's positive and what's negative. And my definition of positive is when the 50-day moving average is above the 200. A very easy way to do this. There are better ways. I just figured, okay, this is a good way to do it. And our list is pretty long, so these words here are kind of pretty small. Growth and value. When you look at them by themselves, they are in uptrends. Copper, the British pound compared to the dollar, gold, silver, the US dollar index by itself, the CRB index, the big software companies, even though they're showing some weakness, the mega caps, the real big honking businesses, the FANG index, even ARC, it's been going sideways, but it's still in an uptrend, but not a really strong uptrend. The low volatility ETF, staples, which is kind of causing us some concern, the Dow Jones Composite Average, and all the different bonds based on price, for right now anyway, even though the world bonds are kind of hard to tell. The tech sector and the semiconductors, and that's a real strength area of the market. High leverage loans, another thing that's really been holding up quite well. The Dow, the NYSE, and the Wilshire 5000. the NASDAQ and NASDAQ 100, mid caps, small caps, and micro caps, all stocks, emerging markets, and Bitcoin. So pretty long list of what's positive. Pretty short list of what's negative. This is when the 50-day simple moving average is below the 200-day simple moving average. We have the Japanese yen to the dollar, and we have the euro to the dollar, and it's barely there. It's not a real strong downtrend. Thank you. I really hope you found this helpful. Please feel free to check out some of the other videos that I post. Have a great Memorial weekend, and I will talk to you in the next video.